Hello, this video is about initial public offerings. I'm your professor, Dr. Stephen Haggard. So a lot of people have fundamental misunderstandings about initial public offerings. So let's try to clear some things up. First of all, what is an initial public offering? You may also hear it referred to as an IPO. And it's basically the first time that the firm shares have been traded on a public exchange. Now here, as of late, we've had some little exchanges pop up here and there where insiders can trade their shares prior to IPO. That's really a very small thing and very few people are involved in that. So what we're talking about here are markets like New York Stock Exchange, NASDAQ, and so forth. Actually, IPOs are a subtype of external financing because this represents the firm going outside of the firm to raise external equity capital. And so we've previously discussed perhaps external financing. This would be a subtype of that, but it garners a lot of interest, so I thought it would be worth talking about this subject by itself. So most people tend to think positively about IPOs because of that first day pop in the stock price. And so let's say the firm goes public at $35 a share, that would be the offer price. And then at the end of the day it closes perhaps at $42 per share. And so everybody looks at that and says, wow, that's great, I should get in on that. Well, I've got some bad news for you, because typically what happens is the only people who receive that $7 gain are the people who were given allocations in the IPO before IPO day. This is a group that likely does not include you. So let's talk about who these people are. First of all, hedge funds, mutual funds, pension funds, so institutional investors, and then wealthy, well-connected individuals. Chances are, if you're watching a video that I put out, you're not a wealthy, well-connected individual, or at least wealthy and well-connected enough to be able to get allocations in good IPOs. Now, you'll receive solicitations for IPOs at the dinner table and through the mail, but these are not good IPOs, and anytime someone reaches out to you offering you shares in an IPO, you should run away screaming, because if it were a good IPO, people who knew what they were doing would have already oversubscribed the IPO, in other words, requested more shares than will be issued. And there would be no need to bother you at the dinner table or send you a mail solicitation to try to raise these funds. So never, 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 never take shares in an IPO from someone who reaches out to you. Okay, so what else have we got going on here? So that first day pop, what does that represent? Well, it represents money that the firm actually left on the table. Getting back to our example, the firm asked $35 for the shares, and at the end of the day, the market said, wow, they're really worth $42. What does that mean? It means the firm left $7 per share on the table. The firm could have asked $42 a share for those shares and sold them for $42. And so it's always crazy. I see these people and they celebrate how much their stock went up on the first day of the stock being traded. And when the managers of the firm do that, what they're really doing is celebrating giving away money, which I think is an odd thing to do. Okay, so where do the rest of us manage to buy our shares in these firms? We manage to buy our shares in these firms on what's called the secondary market, where we buy them from someone else. So maybe we buy them from one of these lucky individuals, or maybe we buy them from someone who bought them earlier in the day and is trying to turn around and sell them before the close of that first IPO day. That's actually a decent strategy if you can get in early, because the shares typically close higher than they open. But it's entirely possible that they would go up and then go down a little bit at close. And so you've got to be careful with these things. My advice to you is don't buy shares on the IPO day at all. Now, back when I was an engineer and had no expertise whatsoever in the stock market, I bought shares in two firms on the first day that they were publicly traded. I bought shares in UPS, which kind of makes sense, and I bought shares in Martha Stewart. Now, you ask, why in the world would you do that? And the answer is my wife wanted them as an anniversary present, and the IPO happened to be around our anniversary, and there you go. Now, why am I telling you about this? Because I took a beating on both of them. And here's why. It's what Ritter 1991 points out, and that is, yeah, most IPOs do go up on offer day, though not all. I'm talking to you, Uber. Not all. And so what we see there is that first day, sure, there's a big pop in the price, but after that, there's like 3 years of underperformance. And so these firms underperform similar firms that haven't just IPO'd for like 3 years after the IPO day. And so these firms are really not a good investment. Now, why does Ritter say this happens? Well, he throws out a few reasons. First of all, risk mismeasurement. Keep in mind that the price or value of anything is the present value of the future cash flows discounted at a rate appropriate to the risk. And so what we've got to think about in that present value formula is what are the different components. Future value, so think about the future cash flows of the firm. Maybe we are misjudging the size of those future cash flows. That would be over-optimism, as Ritter puts it. Or maybe we are underestimating the risk. And if we underestimate the risk, then we discount those future cash flows at a rate that is too low, and once again, we are willing to pay too much for the firm. And then he talks about fads. And what he really means here are what we talk about in finance as hot IPO markets. And we recently had one of these, but they come and they go. And they provide an opportunity for firms to sell their shares for probably more than they're worth. And so you get kind of a feeding frenzy, herding mentality where there are these IPOs. Now, what happened with Lyft and Uber is that they waited too late. It was so interesting. The day that Uber did their IPO, I was watching it on Wall Street Journal website, and I sent the article to my wife about how they were basically selling for less, the stocks were trading for less than the offering price. And her words immediately back were, they waited too late. So they basically waited until the market was no longer hot. But these firms that go public during these hot markets, they receive these higher valuations on the first day. Well, that looks great on the first day, but it makes things challenging going forward. So, which kinds of firms does Ritter say are overrepresented in this underperforming group of IPOs? Well, first of all, younger firms. Younger firms, age is probably a proxy for risk. And so the younger the firm is, the higher the risk. And we actually see that these firms have greater underpricing, which would be consistent with that. But we also see that firms that go up more on the first day tend to perform worse over the next 3 years. And so there's some where the rationalization comes back into the price over the 3 following years. Now, I have to point out that it was really hard for Ritter to sell this argument back in 1991 because this is not consistent with efficient markets. If markets are efficient, it shouldn't take, first of all, the price should not go higher than its true value on the first day. Secondly, if it does, it should revert immediately on the second day, as we all wake up from the hangover and impound this new information into the stock price. But it actually takes like 3 years for this overreaction to get worked and washed out of that stock price. And so this is not consistent with market rationality. Another set of firms that are overrepresented here would be growth companies. And we talk about growth companies and value companies. Growth companies tend to, their value is all about what they plan to do in the future. So for instance, all these electric scooter companies would be called growth companies, whereas someone like Walmart, whose big value is in their current business, would be called value companies. And so it's the growth companies that we see that particularly underperform following IPO. Okay, so what are the practical implications of these things that we've been talking about? First of all, should you buy shares at IPO? Only if you are one of those lucky dogs that actually gets the shares at the offer price should you even consider doing an IPO or buying shares in an IPO. If you're not one of those people, what this means is you're going to buy your shares in the secondary market, you're going to overpay, and you're going to suffer underperformance for the next 3 years. So, my advice to you, based on what we've learned from Ritter 1991, is do not buy these IPO shares. Wait until the company's been public at least 3 years, and then if you still like the company, buy it then. But I'll also give you the advice that we shouldn't be doing stock picking anyway. Just buy the index. You'll sleep better at night, and you'll have more money at the end of the day as a result. I shouldn't say at the end of the day. I should say at the end of your investing career. Because, of course, we have volatility in the meantime, and in the meantime, one of these stocks might just really go high, and you would send me a dirty email and tell me, I invested in this and I made so much money, so you're obviously a fool. Obviously, that could happen. But, on average, you're better off to skip investing in these firms, wait 3 years, and then only buy them as part of a well-diversified portfolio. Now let's say that you're some sort of financial wizard with a lot of cash behind you, perhaps at a hedge fund. What else could you do to make money from what we've learned today? Well, you could short sell the shares of the IPO firms if you can manage to get your hands on them, which is not always easy, and take a long position in these matching firms that Ritter identifies. And by doing so, basically, you're somewhat inoculating yourself from the risks that are buffeting the industry and the markets overall. So these stocks are going to go up and down together based on that. But the long position will gain value at the market rate, and those overpriced internet stocks, or the overpriced initial public offering stocks, they're actually going to underperform, and that'll allow your short to make money too. And so that would be your fancy trade to do if you were so inclined. Now, there is one caveat here. One of the professors that taught me actually knows Jay Ritter and was talking to him at a conference. And this story, might or might not be true. There was a couple of glasses of wine involved. But he basically said he talked to Ritter and asked him, have you invested based on what you learned? And Ritter's answer was yes. And then he said, how's that working out for you? And Ritter said, if it wasn't for Starbucks, I'd be doing great. What did he mean? He bought shares in the Starbucks IPO, and Starbucks actually overperformed after their initial public offering. And so if it wasn't for that one stock, then he would have been doing great investing based on what he'd found. Now, what's the lesson for you here? If the guy who discovered all of this and has all these skills and data available still can't make a good profit doing this trade, perhaps you shouldn't either.